All right, we are live for Finance Friday this week. First one back live after the holiday season. We did a couple of pre-recorded events. It's good to see you guys again. If you're on Zoom, thanks for joining in live. If you're on Facebook, it's good to see you. We are coming to you this weekend from Utah. So I'm in Utah doing some business. So we don't have our usual studio set up, but we will get through this. It's going to be a great course. Now, this week's topic is the topic of investing in mutual funds. Okay, investing in mutual funds. A mutual fund is a financial product. And I want to go over it with you because it's one of those things that most people own and they don't know that they own it. They don't know what it is. They don't know how it works. Most of the time, it's something that just comes with your 401k, right? Or you do a retirement account, and by nature of having a retirement account, now you have mutual funds, right? So what I'm going to do tonight is I'm going to talk to you about the basics of them, what you should know about them. I'm also going to give you some insider information. I used to be a financial advisor for the mainstream financial industry. And so mutual funds are what I sold day in and day out. It's something that I knew like the back of my hand. I still do today. And there's a lot of stuff that I learned after selling them that I didn't know going into it. I didn't know at the time I was offering them that this was how they worked, right? So like, hang in tight. We're going to go over some good stuff. I do want to cover our basic rules. We go over these every week. Number one is have a purpose for being here today, right? So there's really going to be like 3 or 4 main groups that are watching, whether you're watching live, whether you're watching the replay. The first one is going to be people that invest in mutual funds. Okay. So if you invest in mutual funds, this is going to be very relevant to you because it's something you actually own, right? It affects you directly. It's what your retirement is based on, right? So that's going to be one group. Another group is going to be people that don't, right? You might not own them and you might be wondering, well, why do I need to learn about this? Well, for one, like I said, they're offered with every 401k plan out there. So if you don't have them now and you go to a job that does offer a 401k and you don't realize that that has mutual funds and how mutual funds work, you could actually make a financial decision that you didn't know fully about. You could make a bad decision, you could make a mistake, right? Another thing is a big part of my mission, if you're a client of mine, is sharing the truth about money with those around you. Right? Like, why would we learn all of this stuff and change our own lives and then not talk to our parents about it, our siblings, our coworkers, our friends, and our family, because they all do own mutual funds, right? And if you can give them a simple concept that changes their life for the better, that's great. And that's part of why you would learn about this. You might also be watching this where you sell mutual funds. You're like, hey, I'm a financial advisor. I'm a registered representative. And if you're watching this, you're probably going to learn some stuff you didn't know. You're probably going to hear some stuff you don't agree with. And I'll tell you what I tell you every time. I'm not your agent. I'm not your upline. I'm not your broker. So we're not going to have the conversation about why you're right and I'm wrong and why you think it's a good idea. But I will say, do your own independent research. Okay. So those are really the categories. So have a purpose for watching this. Why are you here? What are you going to do with this information? And that's the next part of this is think about how am I going to apply this? As I'm going through this, everything I say for a reason. I want you thinking about why did Jerry say that? How do I apply that? How does that work for me? If it doesn't, and it's not something I would apply, how would it work and how would I apply it if I was in that scenario where it was applicable? That's how I learn, right? So I'm never like, oh, I don't need to know this. There's nothing more for me to learn. I know everything. This is unlearnable. That's the way that you don't learn anything. That's the way that you stay ignorant your whole entire life, is thinking that you can't know it or you don't need to, right? And then thirdly is obviously be a producer, not a consumer. It's really easy to consume content in education. I was talking with a partner of mine today, and also with Katrina from Boston. That's great. I love Boston. I haven't been to Boston. I'd love to visit Boston. I was talking to a partner of mine today, and he was like, whenever we talk to your clients, like they know so much more about finances than any other group we talk to. Why is that? Okay, and I told him because number one, we teach a lot of stuff that people don't usually learn. We teach a lot of information that the top 1% really reserve it for themselves and don't share. But we also teach our clients when they're learning, it's an act of production and not consumption. Right? It's so easy to watch this YouTube influencer and that Instagram influencer and that TikTok influencer and just consume and be able to regurgitate all their content like the back of their hand. Mark Perry and I were on Facebook commenting, if you can't apply something, you don't know it. That's not knowledge. The ability to just watch content and consume information is not knowledge. Okay. Knowledge is demonstrated by competency. What do I do with the information that I have, right? The less I do with it and the longer it takes me to do things with it, the less I can say I know about it, right? So that's really the mindset. And us, like I was telling you guys, our partners notice that. The companies we work with notice that. The vendors that we work with notice that. And it's something I pride myself in. It's something I want you to pride yourself in. As a student of wealth dynamics, I produce when I'm listening to education. I think about how I'm going to apply it. I don't just glaze over and listen to the words and be here for the entertainment of it, right? So those are all the things I'm going to cover. I cover those every week. I always will. Now into our course material. So I'm going to talk about mutual funds. Now, I always start with my backstory. I started in 2011, 2012 as a mainstream financial advisor. I did life insurance, I did mutual funds, I did retirement planning, I did all the things you would sit down and talk to the New York Life guy or the Edward Jones guy or the Merrill Lynch guy or the World Financial Group guy. I did all of that. It was the normal thing, okay? And at the time, I had a very, very low level of financial literacy. So you have to understand my background. I came from a family that, we grew up in poverty. When I was 8 years old, 9 years old, one of those summers, my parents got divorced over finances, all in the same summer. Mom and dad lost the house, right? Got foreclosed on or short sold or whatever. We lost the house. The car got repoed, and then we were homeless, all in one summer, right? I was a free lunch kid in high school, middle school, all the schools. I was a food bank kid where we'd wait in line in freezing cold temperatures to get a box of Raisin Bran that had bugs crawling through it, right? We were a family that in Alaska, there's a list where when there's a moose that gets hit by a car, the lower income families get the moose meat to be able to survive through the winter. We were on the list, right? And I don't tell you that to play my tiny little violin and my sob story about my hard upbringing. I tell you that to show you guys, I didn't know dirt about money. I didn't know anything about anything when it came to finances. Okay, and so when I got into the financial industry, everything was like magic. Everything was like, the Wizard of Oz. Like, oh, I'm talking to the Wall Street guy. Oh, the annuity wholesaler came to my office. That's so special, right? Or, oh, we're talking about a mutual fund and this client's now an investor, right? Everything blew my mind, and it was easy because I didn't know anything about money. I want you to think about this or write this down. When you hear information or when a person hears information and it sounds secret and it sounds magical, that is an actual indication that financial literacy exists in that moment with that person. There are no secrets and there are no magic tricks, right? So when you share a simple concept and it's like, oh, my whole world just opened up. That's evidence that in that moment I was illiterate on that thing, whether it's finances or nutrition or spirituality. And it's not a ding, it's just a condition, right? When you get sophisticated, you start learning this stuff, you're like, oh yeah, I know that. That makes sense. I could see how that is. And it's not as mind-blowing as when you're brand new at this stuff. So when I first learned about mutual funds, it was the most confusing thing in the world because I didn't even know about stocks, right? I didn't really even know about stocks or bonds or any of these individual financial instruments. So all I knew was I was a poor kid from Big Lake, Alaska, and I was never going to own these things. I was never going to be with Wall Street. I was never going to invest in stocks. I was never going to be an investor. I was never going to be wealthy. And so when I sat down and learned about a mutual fund, this is how it was pitched to me, and this is how it really is on a simple level. Let me actually share my screen with you guys here. I'm going to draw some of these concepts out. So a mutual fund would be like this, right? So if I were to own a stock, let's say it's Disney or Apple or whatever, right? This is a share of ownership in a company. And there's different levels of this ownership. There's different types of this ownership. There's preferred, there's common. Let's just say it's just stock for the sake of simplicity. And I buy stock in, let's say, Disney, right? Now, if Disney does well, I do well, right? Now, this is based on the fact that I can afford to own Disney, right? Because Disney goes for whatever it goes per share. I'm going to make up a number. Let's say it's $300 a share, right? I don't know if that's it. I don't look at the stock market, but let's say that that's the number. If I have $300, I could go buy Disney, right? So I would have to have the $300. I would have to have access to a way to go buy Disney. Right now, when I first got started, we didn't have, Robinhood, and you had to go to a stockbroker. You had to go to a stockbroker, and so I had to have access to be able to even go own a share of Disney. Not only that, I would have to have some level of sophistication and knowledge to know that that's a good stock to buy, right? And then with the access thing, like in the money management industry, it's a real thing that there's discrimination. They're going to look at a certain person and say, hey, you don't look like you're a big account. You don't have enough money. We're not going to talk to you, right? You go to certain places, they're going to say, hey, if you don't have $5,000, you cannot open up a brokerage account with us. So you have to have some sort of a means. You can't just have the $300,000 or the $300. You have to have means to be able to open up an account. And so these were all barriers to entry. In my life at that time, I didn't have $300. I didn't have access to a broker to go buy shares of stock. I didn't have the sophistication level to know how to ask for that or to know which stock to pick. And I didn't have the means where any of them would have taken me seriously. If I walked into an office for Merrill Lynch, they would have said, get out of here. You look like you're homeless. But you're the delivery driver. Why are you here, right? So this would happen if a normal individual went to buy stock. Now it's much easier. You can go on Robinhood and all these different platforms, right? But at the time, this was 2011, 2012. This was kind of the reality, right? This is just the way to get into a stock. Now, once you get into the stock, everything rides on that one stock. If I bought one share of Disney, if Disney does well, I do well. If Disney does poor, I do poor, right? If I put, a lot of money into it, that could be really good or really bad. The more money I have, the more leverage goes into whether or not I have a positive or a negative return, right? Same thing with the access. My sophistication level, I might pick a bad stock. I might pick a fake one. Right, back in the early, I think the late 1800s, I think it was the Vanderbilts. The old man Vanderbilt, he actually was conned. He bought shares of stock in a company that didn't exist. It was literally fake stock certificates, got them back to his office and saw the ink was smudged. He already paid the people and they took his money and ran millions of dollars. Right, like he had to almost start over from zero because of that. Okay, so even the most wealthy people sometimes lack the sophistication to pick the right stock, right? And then the means, obviously, the means to not only invest, but what if I lose money? Do I have enough to make it back? Do I have reserves covered? All these different things, right? So when I started thinking about, okay, well, I'm now in the financial industry, I'm brand new, I'm getting licensed, and they say, okay, well, these are all the risks with a stock, and you wouldn't want to own a stock. Let's instead own a mutual fund. And I was like, well, what is a mutual fund, right? I had no idea what that was. So they explained a mutual fund like this. Think of it like a window, right? And so in the window, if you have no panes in the window, right? A pane would be like a divider, right? If you have no panes in the window, what happens if you're playing ball? Here's your little baseball, right? And the baseball goes through the window and there's no panes, right? The whole window breaks, right? The whole thing shatters, right? Not only that, like that's a risk. So not only that, but you might not have money to replace the window after that. Now you have this busted out window. They told me that's what owning stock was like, right? And it makes sense and there's truth to that. If you pick the wrong one and it goes down, you do lose all of the money in that one stock. So they said, okay, so the solution to this is a thing called diversification. Diversification means we're going to add panes to the window, right? And so what that means is if the ball goes through the pane, right, and it breaks this one here, all of these ones are fine. And you have all your money safe because in a mutual fund, you don't own just one stock, you own many stocks. You could own dozens and dozens of stocks in one mutual fund. So if one of those stocks does poor, you're fine because you're diversified, and diversification is a smart financial idea that you need to be focusing on in your life as an investor. And I bought that. I was like, that makes sense, right? I don't want to break the window. That makes sense. Now, the other thing they told me was, okay, well, the other part of this is, you're not a stock picker, right? You're not a stock picker, which means if you were to go out and try and pick stocks, you would have to spend all this time and resources, and you would need to learn expertise and go to college and get all this, information about picking stocks and being accurate with them. And they explain it like this. If you were trying to fly from, I lived in Alaska at the time, if you were trying to fly from Alaska to Florida and you were not a pilot, would you try and learn how to become a pilot and get your own plane and fly it down to Florida? Or would you just go on an airplane and pay for a ticket? And I was like, well, I would just pay for a ticket. And they're like, right. So the mutual fund, that's what you're doing. You have the pilot and he does his job, and those are the traders. And you have, usually 2 or 3 or 4 or 5 traders in the fund, and that's their job, is they professionally trade stocks. And then you have your analysts. So the traders make the execution. Then you have your analysts, and they're the ones that look at the market. And there's going to be, a handful of them as well. And they're professionals of what they do, and they know about the markets and what to look at. and you have all these different staff, and they can give you a professional level of investment, just like buying a first class ticket on the airplane. Right? And all of this made sense to me as they were explaining it, because I was 19 years old. I didn't know anything about finances. And just the idea that a guy like me could own stock was enough. I was like, man, that blows my mind. Right? Now, throughout my career, I sold millions of dollars in mutual funds, millions. Okay, and I did this until about 2016. Right? It was something I was very good at. I was passionate about. I could sit down with you and I could tell you every reason why you should invest in mutual funds. If you had stocks, I could tell you why your individual stocks were a bad idea and you should sell them and you should put them into my mutual funds. If you had annuities, if you had whatever, I could get you into mutual funds. I was very good at that. And it was something at the time that made sense to me. I was like, this is a good idea, right? I just realized we haven't been recording this whole thing, Lexi. I just hit record. So at the time, I thought that was a very good idea, right? Now, here's what I learned after the fact. Okay, after the fact, I realized that a mutual fund is one of the most expensive forms of investing. Okay, it's not actually even what I would call an investment, right? And you might disagree with this. If you're a financial advisor or an agent, you're like, of course it's an investment. You have to go take a securities exam. I would say, okay, none of the actual investments I do require an exam. When I buy real estate deals, it does not require an exam. When I do private lending deals, it does not require an exam. When I buy gold and silver, it does not require an exam. When I do Forex trading, it does not require an exam. When I do life settlements, it does not require an exam. When I do oil and gas, it does not require an exam. I can keep going. None of the actual investments that I do require a financial advisor or an exam or a broker of any sort. And here's the reason why, okay? The reason why is there is a difference between an investment and a retail financial product. A mutual fund is a retail financial product. Okay, and here's how I differentiate that. Here's how you should think about this too. With an investment is an opportunity. It exists on its own merit, right? Anyone that's ever invested in something, you saw an opportunity, right? Whether someone showed it to you or you saw it, and then you went to the party that had the opportunity and you made an offer and you had an exchange, and then you now get an investment return on this opportunity, right? That's not something that's constructed. It just exists. The right circumstances and the right conditions create an investment opportunity, right? That's an investment. Right now, a retail financial product is different. It's manufactured, meaning a mutual fund or an annuity or any sort of retail financial product starts in a boardroom. It starts in a boardroom with bankers, Wall Street, or insurance companies, right? And they sit around and they think about who is our public, who are the people we're gonna try and get money from, right? What do they want and need, and then how do we sell it to them for the most amount of profit without going to prison? And I know that sounds blunt, but I'm telling you that literally is what it comes down to. Is it legal? Because we don't want to go to prison, right? Sometimes they do. You look at some of these guys on Wall Street, they go to prison all the time for stuff. But in the retail world, when you're working with, mutual funds that are going to be in 401k plans, they're very compliant. So that's the first thing, is this can't be something that sends us to prison, right? And that's probably a good thing, okay? But second is it has to be profitable for the company that's issuing it and the agents that sell it. Because the company is not going to sell a product that doesn't make them money. If a company makes a mutual fund, they're not going to do it for free. They're not a nonprofit. This is Wall Street. They're here to slit throats and get paid. Every single documentary you see about Wall Street, it's not good. There's never like name one time you've seen a documentary about how good Wall Street is and how much they've done for people and how they're doing charitable activities and just going around giving out Skittles, rainbows, and unicorns to everyone. No, every time you see a documentary, it's because they robbed, they cheated, they stole, they lied. They paid people off, they bribed, all this stuff. They do drugs, they do whatever, right? And so when these people sit around in a boardroom, Lexi, can you promote Ari into panelist? When these people, I have to do it? Okay, let me promote Ari into a panelist real quick. When these people are in a boardroom, they're sitting around thinking about, how do we make money? That's the purpose of their existence. Just like any entrepreneurial activity should be. It's a free market, right? Everyone should be thinking about that if you're in business. But when you realize you're buying the investment from them, chiefly it is for them to make money first. Versus when I go out and find my own investment, or I go to a private placement fund, or I go to a real estate deal, or whatever else that's not a construct, right? The primary thing is that I make money. There's nobody else that's making the money and skimming it off the top. You see the difference there, right? I go buy a rental property, it's because I make money. I do a lending deal, it's because I make money, right? There's not another group above me that pulls fees off of me and makes money instead. And you can test this by looking at with a mutual fund or an investment in the stock market. What's the only guarantee? They make sure you know it's not guaranteed to perform. They say past performance is not an indicator of future. We can't guarantee anything, any returns, but they make sure that you sign a disclosure saying you understand what their fee is. And you understand that they're going to make your fee, whether they make you money or whether they lose you money. They're going to make their fees. That's the only guarantee with Wall Street, guys. So that tells you by statistic, not by opinion, not by the fact that the person who sold it to you goes to your church or any of that stuff. By statistic, the priority of the investment is to make money for the people that are selling and creating, right? Very different than me creating an opportunity and finding an opportunity. There's no fees involved. There's no middlemen involved, right? So this is the first flaw with mutual funds is it's not a partnership, right? Like if it's not a partnership, then I want to be in a senior position. Senior position looks like a loan. I talk about all the time. I do private lending deals. It's because it's not a partnership. If I'm not a partner, then it is a zero-sum game. It's me versus you. And if something goes wrong, I want protections. I get protections as a lender. I get protections when I can say, hey, I can foreclose and take away the building, right? With a mutual fund, I sign away my life saying, I understand there are no protections. There are no guarantees. You get your fees. I could lose every dime I have and I can't do anything about it. I understood there was risk involved. Okay, on a lending deal, at least if it goes wrong, I can foreclose and get a shitty trailer. And that's worth something. And I can rent that out and I can sell it and I can owner finance it and I can do something with that nasty trailer, right? Or that apartment complex or that storage facility. I cannot do that with a mutual fund, right? So that's the first problem. Now, the second problem, and actually this should have been the first one, but I'm going to say it second, is it doesn't meet our purpose. If you're watching this and you've watched any of my content, what is the purpose of what we do? It's PI greater than set. Passive income greater than savings, expenses, and taxes, right? That's income. It's the income model, not the accumulation model. The accumulation model means I buy a thing and I hope the thing goes up in price so that I can sell the thing to someone else that's willing to pay more for it than I paid so that I can then generate income off of what I sold. Two issues with that. What if the price isn't right and I have to sell at a loss? That's a bad idea. I should never be in a position where I have to sell assets regardless of price just to pay my own bills, right? So that's an issue with the accumulation model. The other issue with it is, what if I run out of things to sell? What if? Right now, the average retiree will. Yeah, the average retiree will run out of things to sell. They will run out of retirement income within 10 to 15 years of retiring. You can look at statistic after statistic. The average retirement balance is about $70,000. Guys, that's not enough to last a year, let alone 10 or 15, right? So we don't want to have to sell off assets. Like, let me just pitch it to you this way. Let's say I was a company and I was trying to get you to invest in me, right? I was trying to get you to invest in me so I could grow. And you're like, okay, great. Show us your balance sheet. Show us your assets. Show us your liabilities. Show us your income statement and your expenses. And you notice, as a company, I have been selling my assets to cover my operating expenses. Meaning I was selling buildings and I was laying off staff and I was selling off shares and parts of the company in order to pay the bills. Would you invest in them? No, I can see several of my clients that are investors with us. They're not going to invest in that. They're like, why are you selling your assets to pay your bills? That's not a good proposition. That shows that you don't have enough income. That shows that you're insolvent. That shows that it's just a matter of time before you run out of things to sell, and next is our money and it's not backed by anything, right? Guys, that is the retirement accumulation model. You're selling shit to pay your bills. You're selling off your assets to pay your bills. That's not successful, and that's how you run out of money, and that's a real thing, and I've seen that happen. It's not fun. It's very sad, right? That's why, 75 years old, you've got to go get the door greeter job at Walmart. People aren't doing that for fun. It's because they don't have another option. They didn't know this going into it. Now, that's the second problem with mutual funds. Do you want to know the third one? The third one is In the mass scale of population, we've not seen an entire generation successfully retire on them. It's still a social experiment. We don't know what's going to happen, right? Like the first mutual fund, I think, opened up in 1929, and they weren't really popularized until the 1980s, which is when defined benefit pension plans went away and defined contribution 401k plans and SEPs and 403bs, they became popular. And inside of those plans were mutual funds. And now we went from like mutual funds being a very boutique product to most of everyone in the world owns one, at least in the United States, maybe not the world. Most of everyone in the United States owns one. We don't know what's going to happen, right? Because what happens with stocks, the stock is based on either the earnings, and most of them have a terrible price earnings ratio. So they're based on earnings, or they are based upon the market demand for the stock, right? If a lot of people buy them, the price goes up. If a lot of people sell them, the price goes down. So what happens when a mass population entered the mutual fund market in the 1980s? And then that gigantic chunk of people retires and they all start selling their mutual funds at once. Don't you think the price is going to go down? Because they're not substantiated by earnings. You look at price earnings ratios, guys, they're terrible. They're terrible, right? You're seeing like a good dividend used to be 4 to 6%. Now you're lucky to get 2. So you're seeing the stock prices go up, and it's not because of earnings, which means it's purely because there's more buyers than sellers. And as soon as that flips and there's more sellers than buyers, the price comes down. No different than your neighborhood. If everyone in your neighborhood sells their house for more money, prices go up. If everyone in their neighborhood sells the houses for less money, prices go down. Okay, so you've got this entire generation of people in the 80s that mass mutual, boom, not like the insurance company, mass mutual fund buyers, and they go in and everyone sells, like that was 80s, 90s, 2000s, 2010, 2020. So let's say they were in their 30s, right? So that means in the next 10 to 20 years, they're in their 60s and 70s, they're going to start selling off. Okay, I don't want to be the one holding the bag when that happens, right? And meanwhile, Wall Street's making fees on the entire thing. They love that, right? So that's the third issue is that part of it. Now, the fourth one has to do with financial literacy, right? Now, this idea of diversify sounds good. Hear me out. It sounds really good. Diversify your risk, right? But think about what is the root of diversification? Why would I need to diversify? And if I needed to diversify so bad, why don't I apply that area to more than one area of my life? Right. So the idea is, okay, well, I should diversify. I should invest in mutual funds and have dozens of different stocks and bonds and whatever. In case one goes down, I still have other ones floating out there. Great. Now, why wouldn't I do that with a spouse? Think about it. Like I could get 15 wives, and if one of them's not good, that's fine. I have 14 other ones. That's not a good idea when you apply it there. Why is that? Because you should spend time understanding one of the wives enough to where you don't need the other 14 of them. You just dive into one of them, right? Monogamy, it's a good thing, right? Same thing with investing. The only reason why I would need 14 wives is because I don't understand them. And I don't have responsibility for them. And I don't pay attention to them. And so I need to have all of them spread out in case one of them or two of them or three of them leaves, right? Not any different with stock. The only reason I would need to own dozens and dozens and dozens of stocks is because I'm uneducated enough that I don't know how to pick the right ones. Right? So I just spread them all out. Now, that sounds like a good defense mechanism, but from a financial literacy standpoint and from an intelligent investing standpoint, if you buy stock the way the good stock investors tell you to, which is by analyzing their balance sheet, looking at their assets, their liabilities, their income, their earnings, all this stuff, how are you going to do that when one mutual fund has 30 to 40 stocks in it? You're going to spend all that time. That's going to be, guys, that's going to be weeks of your life analyzing 30 to 40 stocks. Like, and that's just the analyzing part. That's not even learning how to do the analyzing. It's going to take you years to do that. Like Warren Buffett, I think he spends like 4 hours a day just looking at companies, reading balance sheets, looking at statements. Like, and it's not stuff that's fun and enjoyable, and it's also not passive. Right? So this idea of, okay, well, I can just diversify really means I'm uneducated and I'm not going to spend the time to do the work. Therefore, I'm just going to own a whole bunch of them and hope it works out in the end. Okay, that's not a good investing strategy. That's not even investing. That's low responsibility gambling. If I just pick enough of the right machines, a couple of them are going to win, and it doesn't matter if I lose money in the other ones. That's not intelligent. That's not investing, right? So not only is there 30 to 40 stocks in one mutual fund, you're going to probably own 6 to 7 mutual funds. If you're really doing the diversification, then you're going to own 6 to 7 mutual funds. You're going to have small cap, you're going to have large cap, you're going to have international, you're going to have emerging markets, you're going to have blue chips, you're going to have all sorts of different types of mutual funds. And each one of these is probably going to have 30 to 40 stocks. What's 7 times 4? Right? 4 times 7, I think that's 28, right? So that's 280. You own 280 stocks. Can you really say you understand those? Right? The word invest means to clothe your capital. To clothe your capital. You're clothing your capital in 280 different pieces of clothing. Right? My rule is I don't invest in things that I don't like. I don't invest in things that I don't understand. I don't invest in things that don't fit my goals. I don't invest in things that don't fit me as an investor. Okay? I don't invest in things that aren't vital, and I also don't overpay for investments. Same way I pick my clothes. I pick clothing that I like. I understand it fits me. It fits my goals. It's vital. I actually need to wear it. And it's something that's not overpriced. Okay. I can't honestly say I looked at 280 companies and I like them all. I can't, right? I can't honestly say I looked at 280 different companies and I understood every single one of them. Like I looked at all of their earnings statements and I looked at all of their valuations and I did comparisons and I understood every single one of them. I can't say that. I don't think, like, even some of the stock analysts that build these things can't say that. They're just doing the best they can, right? So it means me, Joe Nobody, right? Like putting money in a mutual fund so I can say I'm an investor, or because my 401k gave me a list and I'm just supposed to pick some. I can't say I understand these, right? I can't say they fit me. I can't say they fit my goals. I can't say that they're vital. I can't say that they're overpriced or underpriced. I can't check off any of those points because there's so many of them there that I can't look at any single one of them and make that analyzation. Right? So that's the issue is you can't, diversification is a terrible idea. What do I do instead? I look at, okay, I'm going to pick 1 or 2 things. I'm going to master those. Right? Justin says 15 wives would be a terrible financial plan. I concur. Same thing with 15 husbands. I think 15 any kind of spouse is not going to work out well. You're going to be on a reality show or on Cops, or on like To Catch a Predator or Dateline or one of those shows, right? But what was I going to say? I was going to say, like, I can't look at any of those things and make that decision. Okay. Now, the other problem with mutual funds is if you're owning them outside of a retirement account, there's something called mutual fund turnover. Right? Mutual fund turnover. Like turnover means when the mutual fund itself sells underlying shares, right? Like we all know what a capital gain is. Like I buy this stock, this bond, this real estate, I sell it for a profit. Now I owe taxes, right? Well, with a mutual fund, there's a scenario where you buy it and you don't sell it. You've kept it. You're buying and holding, but the fund manager sold 1 or 2 or 3 or 4 of the shares inside the mutual fund. And when they sold those shares, they sold them for a profit. Okay. You didn't realize any gain from that. Your share price stayed the same in the mutual fund because all you did was lock in a paper profit that already existed. You're going to owe taxes on that. On that gain within the portfolio. It's like a fractional gain. They sold 1 of 30 shares. That 1 share was profitable, therefore you owe the taxes. That's called turnover. So the more times that happens, the more taxes you owe, even though you didn't sell. Okay. Now here's the kicker. They could sell with someone else in the fund, right? Like they set up the fund, someone else is investing. That person leaves, you buy their shares, and all of a sudden the turnover lands on your taxes because you're the one holding the bag at the end of it. You didn't even reap the benefit of the gain. You weren't the one that bought at X price and sold at X price. You didn't get that. And you're going to owe the taxes, right? Like what other investment is that like even going to happen? And in what scenario is that good? It's not. Like if I was like, hey, you're going to pay taxes on real estate that you never even owned when the gain was had, you would be like, I don't want the real estate. Like keep it, you pay the taxes. I don't want to deal with that. Right. But that's what happens with mutual funds. Right. So all of this to say, like there's a lot and there's a lot of financial advisors that don't even know what I just said. They don't understand that. There's a lot to this. When you're owning a dozen, like several dozen or several hundred stocks, that's not just fill out an application on your 401k plan and hope it goes well. You're actually stepping into a great deal of financial responsibility and risk and a lot of other things that you need to understand as an investor. I'm not telling you it's good or it's bad or the people sell them are good or bad. I'm saying don't do things you don't understand. And I know for a fact you don't understand 100 stocks. I'd be surprised if people watching understand one stock, right? Not to mention that, like, if we go more to just a philosophical standpoint, what even is a stock? Can you, like, and I took all the exams, so I know all the right technical answers, but at the end of the day, what am I getting? Sometimes it's not even a dividend. Sometimes it's just the hope that I could sell it at a higher value later. They can't even promise that. The dividend, even if I get one, is not guaranteed. So what am I actually even getting? Proxy voting, like I can send in a certificate and vote, and they're gonna be like, oh, that's cute. Let's make whatever decision we were gonna make anyways. Right, so I have to look at all these things. Now, the other aspect that I want to talk about is when I'm investing, like most of the time it's done out of sequence, right? This idea of dollar cost average and start early and get into it, as soon as possible and as frequently as possible. What the market is trying to do is create market displacement, right? So you have to look at this. You have to realize who the players are in this market. We're talking about the stock market, right? So you have a couple of groups. The first group you have is issuers. Issuers are the companies that create the stock. Like, hey, we're going to create issue of Apple stock. We're going to sell that on the market. So you have issuers. Then you have investment banks. Okay, you have investment banks. Then you have typically hedge funds. Then you have market makers and institutions. And then at the very end of this, you have the retail investor. This is me and you. If we were to go to buy stocks, we would be the retail investor. So here's how this works. When a stock is created, it's created by an issuer. The issuer is basically promising a share of the company in return for dollars. Right? They're like, hey, for $30 a share, you can own a part of our company. And it may go up in value, it may go down in value. We don't know. There's no promises. We may pay a dividend, we may not pay a dividend. We don't know. There's no promises. These issuers are creating money out of thin air. Because what are they selling? They're selling nothing. They're selling the possibility of something, right? So these guys are making the most money, right? So if we were to say they're making dollars, let's give them 1, 2, 3, 4, 5. Let's give them $5 signs. They're making the most money. Now, when they go public, they usually do what's called a pre-IPO, a pre-initial public offering, meaning they're allowed to bring on investors before they go public. These are investment banks. They'll go to Bear Stearns and all these different companies and say, hey, we want to go and we want to have you guys buy our shares ahead of time at wholesale, basically, before the retail investor gets in. Why would that be? That would be because when you buy early at wholesale, you're paying a lower price than the market's going to pay, which means as soon as it goes to market, the price goes up. These guys can sell for a profit instantly. Like they're buying at discount. They're buying. It'd be like when you're shopping at Costco. You're buying off the shelf at Costco. You're paying retail. If you're like a manufacturer, like warehouse, whatever, and you can buy directly from Costco's warehouse before it goes to the store at a wholesale rate, you could resell that at a profit. So if you were like a distributor of Costco, you're not paying retail. You're getting it at a discount because you can instantly sell it for a markup. That's what these investment banks are doing. So they make the next most money. Let's give them $4 cents. So again, this is called pre-IPO. Most people don't even know this exists, right? Like this might be the first time you're hearing this on this webinar. There's pre-IPO, meaning before the public is allowed to buy it, these elites go in and buy it at a discount so they can sell it immediately. Next is hedge funds, right? So now it's starting to go public. Hedge funds will get in on it. They want to buy it before it gets, widely distributed because again, they're going to get a good price. Let's give them 3 stars, okay, or $3 signs. They make the next amount of money. Next is market makers. Market makers will create a market through buying and selling and market manipulation and advertising. Like when you watch CNBC, I don't know if you guys watch CNBC. When you watch CNBC, anytime you see a commercial about investing, it's from a market maker. They're trying to create buzz. They're trying to get more of these guys excited to buy it, to ride the price, right? So they know at any given price, a market maker can buy and then hype the price up and then dump it. It's called a pump and dump. So they're going to make the next amount of money. Okay, then we have institutions, right? These are our mutual funds, pension funds, like these larger groups. They're going to buy in bulk. They might get a discount. They might not have to pay as high of a management fee or as high of a sales charge up front. They're going to make the next amount of money. Now, the retail is the guy that gets it at the end of the day. They go on E-Trade. They go to their Edward Jones guy. They buy at retail. They're going to pay a commission when they buy it. They're going to pay management fees. They're going to pay whatever they pay, right? But what they're getting is what I call the soup of the day, right? Who grew up in a house like I did, where when you had a lot of leftovers, it ended up either in a soup or it ended up in a casserole, right? This might be socioeconomic insight for some of you guys. Anytime you're at someone's house and you're having casserole, it's almost always leftovers from last week. Or if you had soup, it's almost always leftovers from last week, right? Chinese restaurants and other restaurants do this, where they'll take the product that they cooked up and it's expiring, and they mix it into a casserole dish, or they mix it into a soup, or they give you the special of the day. That's the old food. It's about to go bad. If they don't sell it now, it's going to expire and nobody's going to eat it, right? When you're in a mutual fund, you are buying the soup of the day, meaning by the time you got it, the issuers already made their money. The investment banks already made their money. The hedge funds have already made their money. The market makers have already made their money. The institutions have already made their money. And you're the last guy that they're going to try and make the money off of. They don't want it once they've made the money. They're going to sell the nasty little, fully smoked cigar, and you're going to get the little spit covered stub that they already slobbered on, and they're going to tell you, oh, go ahead and smoke it, it's a Cuban. You don't know any better, and so you smoke it, right? And you don't know that you just got all their bacteria and whatever else, and it wasn't a real cigar. Okay, this is retail. I call it soup of the day because that's what it is. When you get enough retail investors in a market, it causes displacement. It's just like if more and more people get into a pool. More and more people get into a pool, it causes the water to rise. Right? The more water there is in the pool, or at least the more water appears to be in the pool, you can siphon it out. And all you got to do is get another guy to get back in, and it goes back up to where it was. There wasn't more water. It just looks like it. There's more displacement. Right? So when we have, billions and billions of dollars, it might even be in the trillions, I don't know, of people that are investing in retail. That's causing billions and trillions of dollars of displacement, which means not only have these guys already made all their money already, but they're allowed to then siphon it off of the retail, right? Who's ever heard buy low? Like when it's on sale, when it crashes, you should buy more. And when it's high, don't sell it. It might go higher, right? Like these are the little things that we're told by the financial industry, by mainstream financial services. The reason they tell you to buy low is because how else is the price going to go up if the earnings don't? They need more idiots getting in the pool, right? And then when it goes up, they tell you don't sell. Don't sell. It's for retirement. It's long-term. You're not a trader. Don't try and trade. Just keep it. Buy and hold, right? The reason why is they don't want you to sell before they do. Guys, this happened in 2020. We watched in March 2020, the market crashed and that whole list of like 100 CEOs came out. And they all resigned from their companies and sold all their stuff. That was a pump and dump. And immediately afterwards, what happened? Oh, buy low, it's on sale. This is the greatest sale that we've seen in decades, and you should get in now and don't sell. Only the uneducated and fearful sell. You're going to lose all your money if you sell. You should get in. Well, what's happening now? The stock market hit all-time highs again, not substantiated by earnings at all, right? Like I think the statistic is like the majority of the S&P 500 is held up by 4 companies. That's not good, okay? And they're siphoning their profits off the top again. They do things like stock buybacks, where a company will literally borrow money from a bank and they'll pay 2% interest so that they can buy back their stock, because the 2% interest that they're going to pay is cheaper than the dividend they would have to pay you if they kept it. Because they want the profit. They want to reduce the amount that they pay to you, and they want to increase their profits. Guys, like I don't know how else to break it to you. The stock market's not made for you and I. Never has been, never will be. Right? The people that are going around and recommending it, they're a sales and distribution force for Wall Street, for banks, and for insurance companies. Nothing more than that. Doesn't matter if they're a CFP, if they're a registered investment advisor, whether they're your brother-in-law, they go to your church. They're a salesperson for Wall Street. At the end of the day, they're a distribution force for Wall Street. That's all that they are. And the proof is in the pudding of you can go and you find investments without them. Right? Like, what are you really paying these people for? If I was really going to invest in stocks, and I never would, but if I was really going to, guys, I wouldn't do it through a financial advisor. I would go to E-Trade or Vanguard or T. Rowe Price, and I would just go buy discount mutual funds, and I would just do my own thing. Because they're going to do the same exact thing that the financial advisor with the fancy mutual fund is going to do. In fact, there's a report that comes out, I think it's through Dalbar, their financial reporting agency. The average return that a mutual fund investor made over the last 20 years was like 3.88%. Might have been 4.88% annually, right? And that's before inflation and taxes and all this stuff. Okay, inflation this year, they're saying what, 8%? So if the average has been 4 and you lost 8, it means your return is -4 and you're still going to pay taxes on it, right? So the point of this course tonight, and I'll open this up for questions in a second. The point of this course tonight is to get you to think, right? If mutual funds led to financial freedom, the statistics would not be what they are today. We wouldn't see 8 out of 10 Americans are paycheck to paycheck. We wouldn't see that retirees are running out of money, 10 to 15 years into retirement. We wouldn't see that the average retirement balance is only $70,000. We wouldn't see that the average person, has less than $1,000 in savings. If this stuff worked, the stats would be better. And the fact is, it doesn't work. And you can look at the top and you can see who runs this, and you can see who distributes it and who creates it, and you can find out they don't have good intentions. They never have. If they did, you would see movies about how Wall Street was this, benevolent, great group of people that's always helping humanity. And you would see like these inspirational movies about it. You don't see that, right? You just don't see that. So at the end of the day, don't invest in things you don't like. Don't invest in things you don't understand. Okay, don't invest in things that don't fit you, that don't fit your goals, that aren't vital, and that are overpriced. I don't like mutual funds. Okay, I've gone over, these are all my opinions and viewpoints tonight. You don't have to take them. You can totally leave them if you want to. But if I was me watching this course, I would probably come to the conclusion that, man, that doesn't sound attractive. I don't like that. Right? For what? Best case scenario, an 8% return before fees and taxes and inflation. I can make 8% all day anyway, without all of the hassle and all the nonsense and all the fees and all the other stuff, right? So don't invest in things that don't fit those categories. And then number 2 is know the difference between investing and financial consumerism. I firmly believe retail financial products are not investments. They're financial consumerism dressed up in fancy lingo and sexy advertising and prestige. They're not actual investments. And I'll tell you this story to wrap up. When I was a financial advisor, biggest mutual fund I ever sold, $2 million in one account. Okay. And I was 20, maybe 21 years old at the time. And I'm sitting there and I'm talking to the guy, and this is in Alaska, right? So a lot of good old boys, old money, that kind of a mindset. And so I was sitting there talking, and one of his business partners walked in and he introduces me to a business partner. He's like, "This is Jerry. This is my financial advisor." He's talking to me about these mutual funds. And his buddy looked at me and he's like, "Hey, if you can explain to me what I get when I buy a mutual fund, I'll give you all my money right now." Right? Me being, the smart young guy, I was like, "Oh, I know all the answers. I passed the exams with flying colors. I got like a 90-something% on my investment exam." Not normal for people to get that. That's a really high score. And so I was like, I can ace any question this guy has. So he's like, "Okay, so the first question I have is, what even is a mutual fund?" And I explained to him, "Oh, it's a basket of stocks and bonds, and it gives you diversification. It's professionally managed, and yada, yada, yada." He's like, yeah, but what is it?" And I was like, "It's like this one is a basket of stocks." He's like, "Yeah, but what is the stock? Like, what am I getting?" And I was like, "Well, we can't promise anything." He's like, "Okay, well," and he owned real estate. He's like, "With my real estate, I know what it is. I can look at it and say, that's a house. And I know what I'm getting. I'm getting shelter, or I'm getting rent, or I'm getting whatever it is that real estate provides for me." And he's like, I can't give you a dime of mine because you can't actually tell me what it is. You can't actually show me what I'm getting. At the end of the day, it's all hopes and promises. Okay. And when we're hoping and when we're promising, it's fine to hope and promise in God and your mom and dad and your pastor and your doctor, because those are all people you should trust. because they have a track record of doing the right thing, right? Wall Street is not that. Banks are not that. Most insurance companies are not that. You're placing your hope and your trust and your faith into 3 groups, 4 groups that basically have never proven they're worthy of that. In fact, they've done just the opposite. Every chance they got, they've taken advantage of us, right? They've been bailed out on our dime. You look at 2008, that was manufactured. That wasn't some freak accident. You watch The Big Short, that was these people doing that on purpose. The Timberwolf Fund, the fund that Lehman Brothers was selling, right? You can go look at Supreme Court and congressional interrogations where they show emails between the CEO of Lehman Brothers and the Salesforce literally saying that Timberwolf Fund was a piece of shit. We need to sell it fast. Like, this is verbatim. You can go look at that. That's on YouTube, right? Like, they knew it was a bad thing. They knew exactly what they were doing, and they chose to do it anyways with people's livelihoods and their retirements. Don't trust people that aren't worthy of your trust. Okay, and that financial advisor or that life insurance agent that they have meeting with you, that person doesn't know what's going on at the top, right? Like, guys, I was that person. Okay, and here's the thing, is that person, in order to really be able to trust them, you have to know that they're willing to quit their job over something. I said this from day one when I was a financial advisor, because I was against, the whole life agents and the people ripping people off. I didn't realize I wasn't any better at the time, but I would always tell them, like, hey, you can't admit you're wrong because you would have to quit your job, right? When I found out I was wrong, guess what I did? I quit my job. I gave that business away in 2016. I didn't sell it. I straight up gave it away. I quit because I realized I was wrong. What I was doing wasn't helping people. Okay. And if you've been in the industry, the average financial advisor, they're in their 50s, 60s, they're not going to quit a 30, 40-year career. Like, they're going to find reasons why it's okay. Okay. If they're in one of these network marketing companies where they've got, dozens of people on that team, they're not just going to leave, right? You have to be real with yourself. I'm one client, right? And so if I think this and they don't agree with me and I show them the truth, they have to be willing to quit their job. And most of them are not willing to do that. They have too much at stake. They're too comfortable. They have too much dedicated and devoted to the norm of what they're doing now. They would rather just come up with reasons why they're right. Okay. And the result, and the only way you can tell if you're right or they're wrong, is the statistic. At the end of the day, what's happening? What am I getting? And we can't actually know that until you retire and you pull out more money than you put in. Okay, so I'm going to open this up for questions. I do not have my microphone tonight. So what I'm going to do here is just open this up for questions on chat. So we won't be able to go live tonight and mic up. I don't have my studio set up. But if you have questions, drop them on the Zoom chat, drop them on Facebook chat. Let me start with Facebook first here. All right, good to see everybody. Always good to see you, Justin. Jen, good to see you. David, good to see you. Christopher, good to see you. All right, I don't see any questions on Facebook. Let me check out Zoom. Again, guys, questions. If you have questions on terminology that I went over, scenarios that I went over, if you have mutual funds, if you're not sure, you're like, hey, I have a retirement account, I don't know what's in it, that's appropriate to ask. There's no dumb question. My rule always has been, I would rather feel dumb for 5 seconds asking a question I thought was stupid than be dumb for eternity because I never asked. Avery says, welcome to Mountain Standard Time Zone, Jerry. It's good to be here. Let's see here. All right, we have a question from Avery. Avery says, thoughts on what John Bogle has done with the index revolution with Vanguard? Yeah, that's a good question. So Vanguard, for those of you guys that don't know, that's a passively managed no-load fund, meaning it's very cheap. It's commoditized mutual funds. I think that's appropriate. I'm not a mutual fund investor. I would never own a mutual fund. If I was going to, I would probably go through a Vanguard or a T. Rowe Price or the equivalent. All of the reports, all of the statistics show that actively managed mutual funds rarely actually outperform passively managed. And just by nature of you're not paying fees, right? Like your fees are cheaper. So I wouldn't invest in mutual funds. If I was going to, that's probably where I would do it. I think John did an excellent thing because people don't understand the fees, right? Like fees compound just like returns do. right? So a 1.5% fee, it has the opportunity cost of basically costing you about a third of your portfolio over 30 years. About a third of your returns will go to fees. I think the fee ratio is about 1.25%, which seems really little. You hear that and you're like, oh, that's tiny. 1.25, that's not a big deal. They deserve it. Okay, but when you're like, okay, well, I would have had $1 million, but now I only have 700,000, and it's because of that 1.25% fee. That's a different story. So Bogle was able to get the fees down to like 20, 30 basis points, right? Even cheaper now sometimes with ETFs. So again, not my cup of tea. It's not something I like. I don't understand. It doesn't meet any of those points for me, but I do think Bogle did a great thing, making something that was some cases terrible and making it a little easier for the little guy to get returns. Avery asked, what's the difference between a traditional mutual fund versus an index mutual fund? That is a good question. So a traditional mutual fund is what we would call an actively managed fund, right? So the fund managers, typically they're going to be, Wall Street analysts, fat cats. They're going to basically put together a prospectus, and they're going to say, here is the type of fund we have, here's the market capitalization, here are the sectors, and then here's the general purpose of the fund. And then they have to invest in a way that fits the spirit of that prospectus. So they're going to pick their own determination of what are the right stocks, bonds, whatever, to invest in inside of that fund. And their goal is to usually try and outperform the index. Very rarely do they ever do that, okay? Now, the index is a composite, meaning it's a predetermined ratio of different holdings, right? So the S&P 500 is literally the top 500 largest companies in the market, right? So that's a composite. The top ones usually stay the same. The bottom ones, they usually alternate in and out. Sometimes people, they lose their status in the S&P 500 because their company went down in rank, okay? So a passively managed fund, they basically just mimic whatever the market is. So if it's the S&P, you're just going to get, the closest replication of that composite, that S&P 500 as possible. No better, no different. It's going to be whatever the S&P does. There's some variance. You can't say it's a perfect index, but they're going to do their best job to just simply copy the S&P. If you're in a Dow index, they're going to try and copy the Dow. There's no strategy to beat it. There's no active management. Nobody's paying attention to it. They just set it and forget it, check in once in a while, right? So it kind of gives you just the baseline. Now, the problem with this is again, people get into these, and this is where Bogle kind of did harm to the industry. And they were doing the harm to themselves anyway, so it's probably not worse than what they already would have done, but it caused gigantic amounts of market saturation. It made it easy for anybody to go on the Vanguard website, open up an account, dump money in the S&P. And so those indexes ended up getting pumped up in price because it got flooded with a lot of investors, right? Just like anything, if a bunch of people move to Florida, the housing prices go up, right? That's fine, but again, it goes back to what about when these people start selling and distributing, right? So that's probably the best simple explanation I can give on that, Avery, but those are really good questions. Let me see if we have any other questions here. Jen says, thank you for joining. Jerry and Nano can explain so much better than me. Awesome. Welcome, Gina. It looks like that's Jen's guest. Very cool. Good. So guys, I don't see any other questions here. So what I'm going to do is I'm going to wrap up for tonight. If you're watching this and this is your first time tuning in, okay, a couple of things you can do. If you're in the learning phase and you're like, hey, I'm not ready to do anything with Wealth Dynamics yet. I don't know if I'm ready. I don't know if I'm a client, but I want to learn more. Go to our website, wealthdynamics.com. There's a ton of free articles, videos, podcasts. You can also grab a copy of my book. If you go to jerryfetta.com/B2F, that's the letter B, the number 2, the letter F. You get a copy of my book, Blueprint to Financial Freedom. And that basically, guys, that's 10 years of what I've done with my finances, written up, the easy to follow plan where you can start doing that on your own. Or you can recruit us to help. You can say, hey, I want to become a client. I'd like you to help me get through this plan, right? The goal is financial independence. The other thing you can do is if you're ready to become a client, reach out to Nano Aquino. Nano is in the chat. He can connect with you. He's our client acquisition manager. Nano can set up a call, no cost, answer all your questions, see if it's a fit to become a client. We really do look at, is it a fit? We might tell you, hey, we don't think that it's a fit for you to be a client. You can tell us the same thing. It's totally fine. It also might be a thing where we're like, hey, this is great. Let's work together, right? But you're welcome to do that as well. We also do these every week. So if you're like, hey, this is my first time, I just want to come back next time. Next Friday, 10 p.m. Eastern, we'll be back again. I'll be back in my studio, so sound quality, video recording, that'll all be better. But that's all I've got for tonight. So guys, I'm going to tune out. I am in Utah for the weekend. So it's a little bit cold, but I'm enjoying the mountains and stuff. And we'll see you guys all again next Friday. Have a great weekend. I'll talk to you next time.